opportunities in this? So, if it's, as prevalent and you expect it to continue, I suppose that's what you're saying, right?
Yes, I mean, absolutely. I mean, when you look at the growth of Vanguard, it basically looks like an exponential. I mean, exponential growth never continues indefinitely, but there's no natural limit in sight that would stop them to grow above whatever 15% or then 20% and whatnot. And these limits, I suppose, would have to be drawn by regulators. And even Jack Bogle, the founder of Vanguard, said that clearly there have to be limits, and it can't be in the national interest if Vanguard ends up controlling such large swaths of the U.S. economy, and not just in the U.S. but of course in publicly traded equities worldwide as well. So that there's a need to think deeply about what the optimal regulation and limits are. That is like almost universally agreed.
And coming back to the opportunity, kind of, do you think there's any way how to play it from your side, or what to kind of avoid, or what to get into in order to take advantage of it?
Oh yeah, I mean, individually the opportunity is obvious, which is you should buy index funds, right?
All right.
So
just ride in the gravy train, kind of.
Let's be very clear, right? So a lessening of competition tends to be good for shareholders. It's just kind of it's bad for consumers, and it's more bad for consumers than it's good for shareholders. So that's why on net it's bad for society, right? So the individual opportunities, they are obvious. There's also papers in the recent literature showing that active mutual funds that concentrate their holdings in particular industries outperform compared to holding a diversified portfolio, or compared to other actively managed funds. And of course that can have many reasons. One is that because it lessens competition, but another one is maybe these funds simply have industry expertise or whatnot, right? But I mean, but all of that is just to say that from the investor side, there's several proven ways of taking advantage of these developments. That's not a difficult kind of exercise. The difficult exercise is really for the regulator that takes the welfare of society as a whole into account and tries to figure out how to solve that complicated regulation problem.
And do you see this happening anytime soon, or are there any kind of discussions to follow and to see any kind of sort of change there?
So I had enough coffee this morning to feel optimistic. So let me tell you about a few positive, a few examples of where regulation is already happening. Okay. So one thing I may have mentioned earlier is that this doesn't only happen in private markets. It doesn't only happen in public equity markets. It also happens in private markets, right? So SoftBank, famously with the people I hang out with, was, or still is, I don't know that, but was anyways the largest shareholder of Uber, the ride-hailing food delivery yalla company, but also the largest shareholder of Didi, which is the Chinese equivalent, as well as of Grab. That's the ride-hailing
Southeast Asian equivalent.
Exactly, that stuff. And Ola in India, and 99 in Brazil, and so forth. Okay, so like, why would that ever be a problem? And the answer is because at some point Uber tried to compete with Didi in China, right? So prices were low, the payment for the drivers were low, customer satisfaction was high. I mean, I love that as a consumer. But who doesn't love that? And the answer is the shareholder. Who likes competition? Who likes low fares and high driver salaries and like customer satisfaction? It seems like a terrible idea, right? So what happened is that SoftBank brokered an agreement between Uber and Didi, according to which Uber would withdraw from the Chinese market, And to make sure it never re-enters, it would withdraw in exchange for an ownership stake in Didi. So they got about 27% in Didi. And now you know how the incentives work. Well, I mean, if Uber ever were to compete against Didi again, they would hurt the value of their own stake in Didi, right? So that's like a pretty elegant way of just removing incentives to compete. And so this is anecdotal evidence from, you know, the social media in China, but like basically it took a week, and the fares were up, driver salaries were down, customer satisfaction is down, and SoftBank was like, great, why don't we try that again with Grab and try to basically broker the same deal in Southeast Asia. But the other competition authorities, and that's the answer to your question, the other competition authorities went like, wait, we've seen this movie before. We're not going to allow this without further conditions of, you know, divestments of certain arms and so forth. So the regulators in Southeast Asia were actually quite on top of this. Anyways, there are many complications, but I'll skip over those. The Indian Competition Authority also mentioned, hey, if you try to pull that trick in India with Ola, we're going to challenge it. And as far as I remember, they haven't done that so far. So competition enforcers in Southeast Asia were quite on top of it. The European Commission has also made arguments about common ownership of competitors in merger cases, for example, between Dow and DuPont and Bayer, Monsanto, and so forth. So they are on top of that. The US DOJ these days started enforcing a competition law that prohibits directors of one company to also serve on the board of their direct competitors. Right? So you can see why that would be prohibited. But it basically was never enforced, the law. And they started doing that, which is obviously closely related because a private equity company that buys two competitors tends to also put directors on both firms' boards. So basically to weaken the influence of these shareholders on their portfolio firms' behavior, the US DOJ has started enforcing that law as well. So
are there any, just out of curiosity, are there any kind of ETFs or particular investment strategies out there that you looked at that very much have a focus on outperformance through cross ownership, with a focus on that? Because that would be the logical conclusion, no?
Yep. So let me start by. I'm going to have to give you a detailed and slow and careful answer to that. So let's start by, do there exist ETFs that specialize in holding only the firms in a particular industry? And the answer is absolutely yes. If you want to have fun, right? I mentioned airlines a bunch. The reason that I mentioned airlines is because that was the paper, you know, our paper in which we showed a lessening of competition due to common ownership. And there's an ETF called JETS, JETS, focusing on buying all the airlines. All right. Now, whether it outperforms or not, I haven't checked. I don't know that. But I have a strong suspicion that the reason it exists is not because it wants to outperform an index, but for an entirely different reason, right? So the one reason why ETFs exist is because they're way more liquid than individual stocks, and there's a good reason for that. Suppose I'm a hedge fund, and I think Delta Airlines is going to outperform the rest of the airline sector in the next month. But I do not have a view on whether the airline sector overall is overvalued or not. Okay, what I should do in that case is to hedge out the airline industry performance, which would mean I take a long position in Delta, but I short sell the entire industry, right? The old way of doing that, if I wanted to short sell the whole industry, is I would have to take whatever the 15 or whatnot airlines there exist and short sell every single one of them, right? But now I run into a problem, which is in the market for each one of these 50 airline shares, I have a counterparty. The counterparty is scared that I know something about this particular airline that they don't know, and they're unwilling to trade with me, and that causes a lessening of liquidity in that market. It makes it really expensive for me to short sell these 15 airlines. By contrast, if I just go into the market for JETS ETFs, there's no suspicion that because I want to short sell that thing, I have superior information about a particular company. Because the whole point is I'm not trading in a particular company. So this asymmetric information problem in trading goes away, which is a reason why it's way more liquid. Okay, so one reason these ETFs and industry ETFs exist is simply because of active traders wanting to take a short or long position for a short period of time. And they want to do that in a liquid market where they pay lower transactions costs. All right, so let me piece this whole thing together again. Yes, there exist funds that specialize, and ETFs in particular, that specialize in particular industries, but that's not necessarily because they want to outperform it. They just provide a service to investors versus not. But
I meant more the cross ownership, right? Is it like, there's like a couple of players in a particular industry that hold, each other's equity. And, and this index you would expect to outperform, not like, general, obviously, industry ETFs. They're, thousands probably. But yeah, okay. So like, then like, what should we, is there any kind of interesting on that kind of like, is there anything interesting that you might see or that we might see over the next, let's say 12 months that could, confirm or disconfirm the hypothesis that this is continuing? Anything on the regulation side that you are seeing, or any other kind of, interesting signal?
Yeah, so in the next 12 months, there will be a paper appearing on my website that analyzes the stock market reaction to the DOJ's enforcement actions, for example, right? So that might give you a hint about whether shareholders are of the opinion that violating the antitrust laws is a thing that enhances shareholder value or not, and the surprise that suddenly they get enforced, spoiler alert, seems to be reflected in the stock market value. So that's one way one can look at it. But yeah, as I mentioned, there's an entire literature now combing up and down the various theoretical hypotheses this literature has developed over the years.
Is if there's one piece of kind of like content book paper that you would recommend to really smarten up on it, like a primer, let's say, what would that be?
There's no book. I'm kind of smiling because last week I was told I should write one.
I see.
There's not really a book, but that Journal of Finance paper called Anti-Competitive Effects of Common Ownership that you can find pretty much anywhere, including on my website, gives you a pretty good idea of what the point is and what the evidence is anyways, as of 5 years ago when it was published. So that's a pretty good start. I probably want to say a negative thing here as well. There's all kinds of commentary online about that paper in the literature that is simply just completely wrong. The modal reaction in particular by industry was to say like, oh, but we don't encourage firms to collude. This is completely false. To which the listeners of this podcast know the answer, which is, wait, I never said it was about collusion. The whole point, it's not. So there's strawmen out there right and left. BlackRock runs an entire website where they put papers that say wrong and just misleading things about the literature. So you want to be a little careful
marketing,
about
right?
What's that?
It's good marketing, I guess.
Well, yeah, I mean, it's good marketing or obfuscating what the evidence actually looks like. So there's lots of silly commentary on this literature as well out there. So you want to be a little mindful about what you consume there.
Martin, before we wrap this up, how can people follow your work if they are interested? So we talked a lot today about, okay, how these kind of, anti-competitive pressures are building up. You're publishing a paper soon. Like, where can people find it?
So I run two Twitter channels. One is a serious one, and the other one is not. So the serious one is Martin C. Schmalz.
Okay.
And you'll see me post new academic papers on the topic, usually whether I agree with them or not, as well as prevalent articles and developments in the real world. There's another one that's Oxford From, which is somehow loosely associated with my blog View from Oxford, and that's the less serious version. But I also post about work that isn't related to the governance and competition aspect of it, but more of the equilibrium asset pricing notion that we talked about at the beginning. That if we're also successful with this indexing, then expected returns are going to go down. Looking forward. So the other aspects of the diversification problem tend to be posted on that channel.
And what's the next paper that's going to come out on your website as well?
Well, I'm going to make myself extremely unpopular with some co-authors if I mention one paper now. So I think you should just monitor the website and check that out, and then you'll see what the next one is.
All right. Okay, Martin, thank you so much for your time.